Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Markets crushed. Global stocks tumble as the fallout from President Trump's tariff regime deepens. U.S. equity futures are pointing lower still after Asia's worst session since 2008. Oil slides as trade risks increase and Saudi Arabia slashes prices. Middle East stock markets sinking the most on Sunday since 2020. And African impact. President Trump's tariffs set to undermine a 25-year-old pact that gave many of the continent's poorest nations duty-free access to the world's biggest economy. Well, it has just gone 8 a.m. across the Emirates. I'm Joanna Bersachi in Dubai. I was wondering where I can start off the show today. And what I do want to say is if you thought Friday was bad, just wait for today. The price action is brutal from Asia, and you just heard that in the headlines. The worst session for the Asia-Pacific Index since 2008. You have to go all the way back to the great financial crisis, even worse than what we saw in COVID. You have a 10% pullback in S&P over the course of 2 days. That has only ever happened 5 times in history. 1987, the GFC, and in COVID, and now with the tariff tantrum that's happened. So massive superlatives going on in the marketplace. S&P down 6% on Friday. Similar moves for the NASDAQ. Today, futures not doing a whole lot better. S&P futures even now are pointing to an open of 3.4% lower. Same for the NASDAQ. Magnificent Seven. Our colleague Dan Curtis just informed us that since the peak for each one of these individual stocks, they have collectively lost a market capitalization of $6 trillion. $6 trillion of wealth has been wiped out from these Magnificent Seven stocks. So again, the numbers here are just absolutely mind-boggling. Euro stocks futures also leaning towards opening up in the red, down 3.3%. This after a drop of 4.6% on Friday. So again, back-to-back losses, and these losses continue to pile up as the Trump administration digs their heels. The Commerce Secretary saying that there is no hope to postpone the imposition of these reciprocal tariffs coming on Wednesday. And so very little daylight going on here between what was said and what is likely to happen in the next few days despite the volatility in markets. Take a look at the Hang Seng, down 10.7% in the session today. Huge drop. And let me just also point out, remember, Hang Seng was one of the best performing markets of the year this year. It's still technically trading positive year to date, up about 2%, but question marks, of course, about how long that goes on for. Switching over to other financial assets. Here, really important as well to point out the price action that we've seen in Brent. Take a look at where Brent is, another 2% weaker today, $64. Goldman Sachs once again slashing their forecast for where they think oil is going to end up. They now see it ending at $62 by the end of this year, $58 next year. Why? Global growth concerns, tariffs, and the potential for more OPEC plus supply to hit this market. So all of that has happened the last few days, down 15% in 3 sessions. 10-year yield sitting below 4% now, 5 basis points lower. The market is pricing in about 120 basis points worth of cuts from now until the end of the year. So markets are emphasizing the fact that the Fed will have to focus on the growth side of the mandate and perhaps less so on inflation. That is where yields are. USD seeing a bit of support coming in today, but of course, people still questioning this thesis of the dollar smile. In a risk-off environment, you'd expect the dollar to be much higher than where it is currently, but some stabilization coming through, still down about 5% for the year. And then gold, also interesting to note, typically, you would expect more money to go into the safe haven, into the bullion in an environment like this. But the fact that we're coming off does speak of perhaps some people taking off some of their longs, some of the positions that have actually worked out well are being used to fund the deleveraging that's taking place in other parts of the portfolio. So keep an eye on the price action in gold too. Okay, let's go back to the Asian session because there is a lot of red on the board. Avril Hong is in Singapore and can break down all of the price action for us. Just tell us exactly what is going on. The Hang Seng is down 10%, Avril.
Jumana, this is not your typical selling. This is panic on the streets. You look at how these indices are just flashing across on our heat map. The region's benchmark, as you cited earlier, steepest decline since the global financial crisis. Investors are here really grasping for references. Is this the worst we've seen since the pandemic, GFC, or do we have to go further back to the dot-com bubble bursting? On some of these gauges in the region, just highlighting on the Singapore benchmark, the steepest steepest declines that we've seen on record. Similar picture for the TAIEX. Chinese stocks are down. That bleed on the Hang Seng, steeper since the 2008 of October. But we are seeing also potentially not as bad as some of the other indices in the region. Maybe some of this with the national team buying and the hopes of potentially some other measures to help the Chinese economy buffer. But this is also a confirmation that China is part of the equities pain, back from a long weekend, and really here traders coming to terms with this reality that the US-China trade war has entered a different phase. Now, aside from what we're seeing in stocks, the FX space also getting really hard hit, commodities as well. What's doing well? It's bonds. They are the ones that are showing that climb, Jumana.
Avril, thank you so much for giving us the overview. Just another enormous day when it comes to markets and the price action that we're seeing. Let's stay on these markets. Investors are bracing for another wipeout session on Monday in the U.S.
I think the hardest thing for the markets right now is not only to try to evaluate where the destination is, but how bumpy will the journey be.
There's going to be stickiness to these tariffs. And even if there are some negotiations and some concessions along the way, I think the direction of travel here is very clear. Tariffs are going to be high, and I think they're going to be high for a while.
If you go back to Friday, the Fed can talk tough. They have to be looking at this. I don't know if they can even make it to the May meeting before they start bringing rates down. I think this is a serious moment. I do not think the Fed can just sit on the side.
In the past, the Fed, like in 2018-19, blinked when there was a real massive spike in high-yield spreads. And if things continue this direction, high-yield spreads are going to go even higher, and that's a breaking point.
Joining us now is Norman Villamin, the Group Chief Strategist at UBP. Good morning to you. So what do you make of the price action this morning? It started off in the U.S. on Friday, but of course now every single market around the world, from Europe to the Middle East to Asia, is deeply in the red.
Yeah, markets are trying to price the new environment. Clearly, we've seen valuations compress around the world from here. That's really the first leg. We don't think we're done with that. The next leg is going to be, we expect our earnings expectations need to be adjusted for what is going to be a much poorer economic environment as we go into the second half of the year.
What do you think is necessary right now to turn sentiment around? We heard from the Commerce Secretary over the weekend. He said that there's no hope of these tariffs being postponed. President Trump is saying, hang on tight. It's going to be painful, but ultimately things are going to work the way they want it to. What is necessary for investors to see in order for things to actually start stabilizing?
I think what investors need to see is some clarity on what these tariffs mean for the real economy. How deep is the slowdown going to be? How high is inflation going to go as a result of these tariffs? And until they get that, then what they're going to have to do is move to the sidelines. And I think that's what we're seeing in markets. Because markets, to be honest, right now, if we look at global equities, valuations are about where they have been historically average. Rather than extreme valuations to the downside, and markets may need to probe that given the uncertainty about the economic outlook.
Yeah, but this is an environment where people are thinking about valuations. They're just probably looking at their portfolio and de-risking because there's so much uncertainty about what's to come. So I do wonder what the catalyst is going to be for that point of stabilization. What are you recommending for clients to do right now if they're in any of these widely held positions that the market has enjoyed at the beginning of the year? I was just talking about the Hang Seng. Up until a week ago, it was one of the best performing equities around the world.
Yeah, look, I think one of the keys right now, especially in the equity market, is looking for those foundations of, one, valuation, 2, earnings, and then 3, what not a lot of people have focused on in terms of equities going back historically is dividends, because we think those kinds of floors end up being much more durable, and that gives you a sense of where you find value in equity markets. I think the second piece of the puzzle, again, for the longest time, equities have been the place to go. Everybody has been in equities. Cash, not very interesting. You want to have that foundation of stability in portfolios, not only in cash, but also we've been advocating for the last few years fairly substantial positions in things like gold from here to be able to weather periods of volatility.
Yeah. What's interesting about gold is last week it actually ended the week marginally lower. It was about 2.7% weaker on the week compared to everything else. Obviously, that's a massive outperformance. But to me, that speaks to the fact that people are reducing positions across everything in their portfolio, the winners and the losers. It is a massive deleveraging, a massive de-risking that is going on. Do you think the gold trades could also be at risk here?
I think you're exactly right. What we are seeing across asset class is a deleveraging, and gold is not something that is going to be immune from that. Look, gold's been in a multi-bull market here. It's not a surprise that some people were using leverage to participate in that. And what we're seeing in markets, that's going to force some of that leverage out of the system. And so we do want to recognize that that is a possibility and size positions accordingly. But we do think as we look more medium term, we think gold will continue to serve as an anchor of it, in particular inflation-adjusted wealth preservation for our clients.
In an environment where there's a volatility spike, there's a hunt for liquidity, do you think that investors are going to reach for the assets, therefore, that are the most liquid? And in that environment, you're looking at some of the most liquid currency trades, and away from some of the perhaps more or less liquid or less traded parts of the market, like credit markets.
And so when you get this deleveraging that, as you rightly point out, is taking place, again, you can sell what is liquid to you. And so if you have illiquid assets here, those will not be readily available to sell. And so where people will have to go to will tend to be the liquid asset markets. That's publicly traded equity, publicly traded bonds. And I think that's what we're seeing. Then over time, you're going to see a reallocation of the portfolio overall, and that will include some of the illiquids that people have been allocated to over the last few years as well. And so it will take time, but we expect that that will move through those segments of the economy as well.
Yeah. Well, thank you for coming on our show today. So much to talk about these market moves. Norman Villamin, Group Chief Strategist at UBP. Well, still ahead, Israeli Prime Minister Benjamin Netanyahu is in Washington to meet President Trump. A look at what's on the agenda next. This is Bloomberg. Checking in on markets here in the Middle East. Trading yesterday, take a look at the Tadawul. The Saudi index dropped almost 7% in trading. Tadawul banks down almost 7% as well. Aramco, the likes of Aramco, shaving off about $80 billion from market caps. It just tells you that a lot of the fear around the world is also seeping into some of these local markets. And not just that, but also keeping a close eye on the price of oil, with oil dropping 15% in the last few sessions. So that was yesterday's close for Tadawul. Now, Israeli Prime Minister Benjamin Netanyahu is due to meet President Trump in Washington to seek a better tariff deal and to discuss the war in Gaza. The meeting was prompted by the 17% tariff the U.S. is due to impose on some Israeli goods, which Netanyahu hopes to escape or reduce. Joining us now is Honor Ant, Bloomberg's managing editor for Middle East and North Africa. Well, Netanyahu will be the first foreign leader to meet President Trump in person since the tariff announcement. What is he going to be looking for?
Well, that's very similar to what happened back in January after Trump was inaugurated. Again, Netanyahu was the first to speak to him. Well, as you said, on the one hand, he's looking for a discount or a reduction in the tariffs that targeted many countries around the world, although arguably Israel was one of the sort of lesser hit countries by Trump's tariffs. So he's going to be looking for a reduction there. But I think equally importantly, what Netanyahu was going to be discussing with Trump is obviously the ceasefire, the attempts to revive the ceasefire in Gaza, where conditions are dire, and obviously some other regional issues, including the recent rise or spike in tensions with Turkey over their sort of comparable influences, spheres of influence inside Syria, which seems to be a serious security concern for Netanyahu.
I'm curious to see how much of this conversation is actually going to be about tariffs versus the situation in the Middle East and the fact that the Gaza ceasefires effectively collapsed. Since the airstrikes resumed, more than 1,300 have been killed, according to the Gaza Health Ministry. You had a situation over the weekend with the killing of 15 medics that was all over the news. What concessions do you think Netanyahu would be looking to extract on that front? Or do you think this visit is mainly going to be about the economic impact of the tariffs?
No, ceasefire is definitely going to be a major issue, possibly the key issue that is going to be discussed. But also, I think we should remember that it seems that this meeting has been initiated more by Trump's insistence that Netanyahu goes there immediately rather than the other way around, which I think makes me think that there is possibly going to be some push by the U.S. On Israel as well to sort of resume talks. And basically there have been back and forths between Hamas and Israel in recent weeks over how many hostages or which hostages can be released to announce at least another temporary extension to the ceasefire. That's going to be the key. And I'm not sure if Netanyahu is going to be there to get any or extract any concessions on that front.
Yeah. Okay. Honor, thank you so much for the overview. We'll await what happens at that press conference later. Honor Ant, Bloomberg's managing editor for Middle East and North Africa. Well, still ahead, a U.S.-Africa trade pact is in jeopardy after President Trump's reciprocal tariffs. The details next. This is Bloomberg. All right, checking in on markets once again. Another heavy session. Looks like it's gonna. This is the board, I should say, in front of me. I can't even speak given how big these market moves have been the last couple of days. The S&P futures are leaning towards the red, down 3.5%. Nasdaq down 4.4%. This would put the S&P declines at 10% in the last couple of days. That has only ever happened 5 times in history over the course of 3 events: 1987, the GFC in 2008, and of course COVID as well. So back-to-back losses for S&P, for Nasdaq. European markets as well seen opening the red, down 3.7%. And take a look at the MSCI Asia Pacific, down 7.5%. This is its worst session since 2008. You've got the Hang Seng trading 10% weaker today in trading. So huge moves in the equity space, and not just equities, other financial assets as well, including oil, which is down 15% in the last 3 days. But President Trump's tariffs will undermine a 25-year-old pact that gave many of the poorest African nations duty-free access to the world's biggest economy. According to a White House official, the tariffs, as high as 51 or 50% on the Kingdom of Lesotho, will supersede the African Growth and Opportunity Act.
If these effects continue and we start seeing changes now in interest rates, then that's when, and the ability of, say, diaspora outflows from the U.S. into the African continent, or even other countries, that now starts becoming an indirect impact on many of the African economies and many of Africans who rely on some of those inflows.
Bloomberg's Jennifer Zabazaja joins us from Johannesburg with the details. Jen, maybe just as a reminder to our viewers, walk us through exactly what the AGOA trade deal actually was or is, and how the imposition of tariffs now could throw that agreement into jeopardy.
Right, Jumana, I mean, the way you phrase that is pretty significant because AGOA, as you mentioned there, has been a cornerstone of U.S. policy for 25 years. It was signed into law by former President Bill Clinton and actually expanded, Bill Clinton, a Democrat, expanded by former President George Bush in 2004. And as you mentioned, it did offer African countries access to the U.S. market, duty-free access. And for a number of these countries, it was not only an opportunity to expand who it was that they were exporting to, but also diversify away from just focusing in on extractive industries. And instead, a country like Lesotho, you were mentioning there, a lot of their exports to the U.S. has been focused on textiles. So yes, it has been very important for a number of African countries. But what's key here is that it's actually been, it expires at the end of 2025. So even prior to President Trump coming into office, we were talking to many officials, including the EcoBank CEO there, about what the future of this looks like if it doesn't get renewed. Now we're talking potentially about these tariffs superseding AGOA, whether or not it's renewed or not. And so many of these African countries are having to contend with the fact that potentially AGOA is not renewed. Potentially they have to look at some new trade deals. And not just that, many of these countries are on the list, as you can see there, of these tariffs that President Trump has instituted, including Lesotho, which is our neighbor here in South Africa, a very small country, but key in terms of exports of diamonds, of textiles. And as the trade minister there in Lesotho called it, if we do in fact see AGOA not renewed and these tariffs continue to be instated, this could be disastrous for their economy.
Yeah, and Jennifer, I guess the question that people are asking is also whether this opens up an opportunity for China to step in, with the U.S. withdrawing, putting up trade barriers, protectionism with the African continent. This marks a sharp turnaround from, say, the Clinton era. What is ahead for these African nations, and is there a possibility that they will increasingly have to turn more east?
Right. And Jumana, if you look at a lot of the nuances and the details of this policy, much of it was America at least trying to insert their soft power onto the continent here. And as we continue to see that eroding with the Trump administration, as you mentioned, it does open the door to other potential trading partners like China and others. But that is something that the U.S. had prior to this administration, to a certain extent, had at least tried to prevent. But what's actually interesting, and I spoke to our Bloomberg economist, our Africa economist, Yvonne Mango, about this in particular, and also Jeremy Awori, if we do continue to see countries like China and others also facing tariffs, this could continue to have even more downstream and detrimental effects on the African countries. And so they're trying to diversify. Potentially they could look at that. But still, America is a very essential trading partner. And so many of them are trying to see what, if anything, they can do to negotiate.
Yeah. Jen, thank you so much for the update there. Bloomberg's chief Africa correspondent, Jennifer Zabazaja. And as we were speaking, just to point out, the MSCI Emerging Markets Index has now fully erased its gains for the year, dropping 6.9%, the most since COVID. That's your market board. We'll be back in a moment talking more about what's been happening with the Middle East markets as well. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Markets crushed. Global stocks tumble as the fallout from President Trump's tariff regime deepens. U.S. equity futures are pointing lower still after Asia's worst session since 2008. Oil slides as trade risks increase and Saudi Arabia slashes prices. Middle East stock markets sinking the most on Sunday since 2020. And African impact. President Trump's tariffs set to undermine a 25-year-old pact that gave many of the continent's poorest nations duty-free access to the world's biggest economy. Well, it's just gone 8:30 a.m. across the Emirates. I'm Johanna Bersachi in Dubai, talking you through this market route. We thought Friday was bad. Today is even worse. Asia Pacific indices taking a massive tumble this morning. This is the Hang Seng down 10.7% in trade. The Asia Pacific index, its worst day, not since the global financial crisis. You have to go all the way back to 2008. So it's really been a long time since you've seen declines of this magnitude. Similar theme playing out, obviously, for U.S. equity futures. You can see S&P down 3.7%. This would be its fourth back-to-back day of losses. Yesterday, on Friday, I should say, the S&P closed down almost 6% weaker. 10% declines in 2 days. You have to go again all the way back to 1987, the GFC and COVID to get losses of this magnitude. NASDAQ down 4.6% in trading as well. Magnificent Seven, I was saying this at the top of the show, have lost a collective $6 trillion in market cap since the peak. So there you go, a lot of wealth being wiped out there. And then, of course, European indices also looking to open up in the red, down 3.8%. Let's flip over, because a lot of emphasis on the price of oil as well. We've dropped 15% in 3 days. Today, Brent is another almost 3% weaker on the session, trading at $63 handle. The likes of Goldman now slashing their oil forecast once again, unconcerned about the possibility of a U.S. recession, on growth concerns around the world, the impact of tariffs, and, of course, that potential extra supply to hit from OPEC that is, again, keeping a lid on how far this market can go up. So Brent trading at $63 now. 10-year yields back at 3.93. Through 4%, another 6 basis points lower on the session. Flight to quality going on there. USD stabilizing a little bit, but of course the theme of last week was dollar weakness, even with all this risk off going on. And then gold also pulling back a bit. This is surprising, down 0.4%, and really speaks to portfolio de-risking. Another part of the market that I've been watching very closely as well, that you want to keep a close eye on too, is what's been happening with credit. So take a look at this. This is junk bonds, so high yield spreads. Up until, I would say, about a month ago, had been trading very strong, even with some of the uncertainty in global equity markets at the beginning of the year, the fact that U.S. equities were underperforming. Credits, hang on. But that has changed. In the past week, we saw a massive falling out of these junk bond spreads, the biggest actual tumble since March 2020, obviously since the pandemic. And there you can see we're only back to 2023 levels. But the fact that credit spreads has started to widen does tell you that people really are concerned now about not just the possibility of slower growth, but also what that might mean for defaults and the credit picture. So keep an eye as well on what's been happening with some of these high yields and also some of the investment grade credit spreads too. But let's go back to these markets in Asia. I was just walking through the session and the fact that the Asia Pacific market has had its worst session since 2008. Hang Seng down more than 10%. And of course, Avro, one of the questions people are asking is what China are going to do with the currency and whether they will allow for a more rapid devaluation of the yuan here.
Yeah, and I think we're seeing arguments for and against, which I'll get to in a bit. But just walking through this panic selling, there's really no overstating the impact that we're seeing across assets, across geographies, and in stocks across all sectors. The key difference this time around, for those that are looking back to March 2020 per se, is that the Fed doesn't even sound like it's going to swoop to the rescue. Sounds quite cautious, and it's very telling. The likes of the Singapore benchmark, usually looking quite stable, is plunging by the most on record. Among the assets, we're also keeping an eye on China bonds. That surge there is prompting yields to almost the lowest on record. Now, to your question, flip the board of what China might do. You think back to the first trade war. This chart from our very own Veritel shows you how the currency depreciated about 10% in the U.S.-China tariff conflict. This time around, strategists are saying 30% as much as in terms of the yuan devaluation. But we also have the likes of Mizuho saying that today, when they weakened the yuan fix, it was actually directed more at allowing two-way flexibility on the renminbi in order to deal with this volatility, and that China ultimately does not want to see significant devaluation of the yuan. Simple reason, because what this would mean for capital outflows as well as to anchor growth expectations. So this is what you're seeing, the potential responses that we're seeing from China.
Yeah, makes sense. And certainly in an environment where there's already stock market volatility, they probably don't want to make things worse. Avril Hong in Singapore, thank you for the overview there. Now, over in this region, Saudi Arabia has slashed its flagship oil price by the most in more than 2 years, just days after the OPEC Plus alliance announced an unexpectedly large output hike. It comes as Goldman Sachs also cuts its price outlook for the second time in under a week, citing growing recession risks. Joining us now is Bloomberg's Middle East energy markets reporter Anthony DePaula. Well, Friday, you and I had a conversation about the decision out of OPEC Plus that surprised everybody and sent oil markets a lot lower, that in conjunction with the tariff news. And over the weekend, we found out now that Saudi have officially lowered the official selling price, that they're selling oil to Asia. Are the two related?
Yeah, good morning, Jemima. So back again so soon, and lots of oil news, and it's not good in terms of pricing and in terms of the potential outlook for demand if we put all this stuff together. So as you said, that additional oil coming onto the market from OPEC in the month of May, what we saw from the Saudis over the weekend was their official selling price for the month of May. So what they do is they put out differentials. In this case, it's a discount that they'll apply to the price of Brent. Effectively, that's the global benchmark, and that is what sets the price that the customers will buy. Those refiners in Asia mainly, lots of buyers in Europe as well, but Asia is their main market, and that's what we're looking at. So that's where this biggest cut in about 3 years since 2022. That was more than the refiners expected because already they're looking at a market with some weak demand, some poor margins. Then on top of that, you've got this additional supply, so the Saudis need to bring that price down even more in order to get these buyers to buy that because they've just got more choice in the market, more barrels, so they are overwhelming demand a little bit there.
So is this about increasing/maintaining market share as opposed to stabilizing the price now? Is that the calculus, do you think, from Saudi Arabia?
Yeah, well, this was that change in policy that we saw last week from trying to support that price to getting back some of that market share. Now, we've seen the price just dropping. We've lost over $10 on both WTI and Brent since last week, since before these tariffs were introduced by the U.S. administration. So that's having a massive impact on oil. So the Saudis are saying, basically, let's put that oil back on the market. Let's get some of that market share back. We're in a lower price environment. Yeah. They can't control the market based on the tumult that the tariffs and the uncertainty around what's happening with U.S. economic policy, what that has caused. So I suppose they're figuring we might as well get some market share back. Plus, Trump wants to bring back American oil. If they're bringing the price down, that makes that even more difficult.
Yeah, well, with the prices this low, probably it disincentivized many of those shale rigs to keep drilling. Anthony, great to have you on, as always, breaking it down for us, all of these energy moves. Anthony DePaula, Bloomberg's Middle East energy markets reporter. But let's talk about stock markets now, because the Middle East is not escaping the global market meltdown. Main equity benchmarks in the region, including Saudi Arabia's, sank the most on Sunday since 2020. So for more, let's get out to Riyadh and speak to our Saudi bureau chief, Christine Burke. Christine, good to have you with us on such a day. And obviously, many of these markets are open for trade on Sunday. So we got a glimpse of what the trading week was going to look like. Huge pullback for the Tadawul and others in the region. What was the catalyst here? Was it tariffs or the fact that oil prices have been plummeting so much the last couple of sessions?
Well, good morning, Joanna. You make a good point there that these markets only reopened on Sunday. So a lot of what we probably saw was down to investors getting their first chance to react to the escalation in the global trade war that we saw on Friday, and also to the further drop in oil prices. But when we look at tariffs and we look at the drop in oil prices, it's probably the latter that is really pressuring these Middle Eastern stocks and Middle Eastern economies. Already we have seen a number of voices out there, a number of Wall Street banks commenting that tariffs across the globe could dent global economic growth and weigh on global oil demand. When you consider that OPEC Plus is also set to add about 500,000 barrels a day back to the market in May, and you can see why we are seeing such a drop in oil prices at the moment. And really, if we are set for a sustained period of lower oil prices, then what we can possibly expect to see are lower oil revenues for some of these major Middle Eastern economies. And that is really where there is a lot of risk here. Amwal Capital Partners saying to us yesterday that it's the knock-on effect effects on oil from these tariffs that present a major risk to these Middle Eastern economies and threaten to slow down spending on economic transformation agendas. Because remember, these Middle Eastern economies, while they are trying to diversify away from oil and are doing so rather successfully, they still do rely heavily on elevated oil prices to back spending and to back investment in the economy.
Yeah, and yet, Christine, there's still a lot of relative positives for the region as well. Even though the 10% they received, obviously the 10% broad-based tariff, they fared better than the rest of the world and are immune to these higher reciprocal tariffs. At least most of the countries in the region are. And geopolitically, perhaps you could say, are in a better position than other countries around the world or other blocs around the world, being perceived to be, quote, geopolitically neutral from Trump's perspective. And so what is the major risk ahead? Is it purely a function of what happens to the price of oil from here onwards?
I think really that is the major risk that we are talking about here. And I think we need to be a bit careful and do take note of the fact that voices out there like Amwal are saying that when you look at the long-term fundamentals of the GCC region, there is no reason for panic. And part of that is down to the fact that many of these economies are politically aligned somewhat with the U.S. The tariffs that we did see of 10% are relatively low in comparison. And also, when we consider high FX reserves, strong sovereign balance sheets, it means that these Middle Eastern economies are in a sound position to weather a global downturn. But in the short term, we do need to take seriously the fact that lower oil revenues will further pressure economies like Saudi Arabia, which has already been forced to recalibrate spending and investment and is already forecast to run budget deficits through 2027, just due to the pressure of low oil prices. So really, we're looking at potential cuts to spending in Saudi Arabia, namely, as one of the key knock-on effects that we could see here in the immediate future if we do see that these lower oil prices stick.
Yeah, and not least to mention potentially more external borrowing as well to finance some of that deficit. Christine, great to have your perspectives. Thank you. Christine Burke, Bloomberg Saudi Bureau Chief. And coming up, Careem Pay Vice President Mohammad El Saadi joins us with his outlook on tariffs and the company's expansion plans in the region. All right, checking in on the markets here after the heavy sell-off witnessed over the last couple of trading sessions. Today isn't shaping up to be much better. S&P futures down 3.9%, NASDAQ down almost 5%. Asia Pacific, this is the broad index. All of these indices combined down 7.7%. The biggest declines taking place in the Hang Seng index in Hong Kong, which is down 10.7% now. So really substantial moves, massive pullbacks that we're talking about, staring at, and no signs of stabilization as we're in the middle of the Asian session, heading into the beginning of the European session. All right, Careem Pay is expanding its remittance business into Egypt. Mohammad El Saadi, Vice President of Careem Pay, joins us in the studio. Really good to have you with us. You know, I was surprised to even hear about the Careem Pay app, I've got to say. Most people associate Careem with a ride-hailing company. So just talk to us about where Careem Pay fits into the bigger picture of what Careem are trying to achieve.
So Careem started close to 13 years ago now, and as you rightly said, it's a ride-hailing app. We've gone into a massive transformation journey over the past few years, transforming into a true super app for the region, particularly here in the UAE. So we've expanded to food delivery, grocery, and now remittance.
Yeah.
And the reason for this is ultimately our mission is to simplify the lives of people across the region. And when you look at the market like the UAE, super expat heavy. We've got 80-90% of the population that's expat. Everybody needs to send money home. It was only natural for us to bring this simplicity into the Careem Pay app as part of this.
What is happening to remittances during this time of volatility? What are you seeing in terms of volumes and also increased appetite to perhaps send more remittances back home?
So it's interesting. I mean, on the one hand, we're we're on a stellar growth journey as Careem Pay overall, as we're getting more and more customers finding out about remittance, finding out about the experience that we deliver, the kind of convenience, rates that we offer, and the speed at which we enable the remittance services back home. But if you look at the markets more broadly, so first thing to note is, as tariffs hit in, one of the first things that impact remittance is the actual USD to the currency rates, effectively exchange rates, right? So with the dirham pegged to the dollar, movements in the US INR value, for example, US pound rates actually have a direct impact on how much people want to send home. So in the past, what we've seen is, as the dirham, for instance, has spiked relative to the Indian rupee, customers would actually send more money back home, taking advantage of the opportunistic improvement in the rate. Now we're expecting, it's a bit of a, let's see what happens, because there are kind of two different factors coming at the same time. One is, as the dirham weakens relative to the rupee, people will need to send more money to sustain the same level of income that they're trying to support their families back home. On the other hand, what we are seeing is a lot of customers who are sending money opportunistically to invest in the stock market, for instance, that volume will start to come down.
Interesting. How big of a challenge is adoption in some of these countries? Because again, we're talking about countries that don't have a high digital penetration. There are many cash-heavy economies. How much of a challenge is it to get people onto an app like Careem Pay and to use your app for remittances as opposed to one of the others?
So the way our app works is, if you're in the UAE, you're on the Careem app, it's actually a very highly digitized customer base, and one which is actually adopting digital remittances at an alarming speed, honestly. It's been wonderful to see. On the other side, in the receiving corridors, typically most of our customers are well-banked customers on Careem. So they are sending money back to their bank accounts. In some markets, we do offer wallets and cash pickups, which do not require them to download the Careem app on the other side, right? But what we are seeing is, given that the kind of in the UAE, the frame of reference is sending money through your bank account, which tends to be a lot more expensive, a lot slower for the transaction to go through. We're seeing a lot of appetite for customers adopting it.
Who do you see are your biggest competitors? Is it the banks or other fintechs offering similar services?
So I think,
and how do you compete?
Yeah, great question. So I think with us and other fintechs, we're riding the same wave, right? And the reality is we are trying to change the way things are done in the market today and move customers away from paying exorbitant fees. Honestly, at some points, FX rates which are quite unfair to customers, and doing it with a much better experience. So today, the way we differentiate on Careem is most people in the UAE are already users of the app. They already have their debit card saved with us. They have a trust in us. They don't need to download another app. So the simplicity of the experience that we offer is a big advantage, and we are consistently one of the most competitive players in the market.
Yeah, final question I've got to ask you, because it's so big in the region. Any plans to introduce a corridor for digital currencies?
We are exploring. Let's put it
I'll take that as a maybe. Awesome. Thank you so much for joining us today on the show. And I guess watch this space. Mohammad El Saadi, Careem Pay Vice President. And coming up, copper prices rocked by one of their worst sell-offs in recent decades due to President Trump's trade war. A closer look at commodity markets next. This is Bloomberg. Well, checking in on the markets once again, a historic couple of days. Really, there's no other way to describe what we're seeing right now on these screens. S&P futures down 3.7% after closing down almost 6% on Friday, down 10% in 2 trading days. That's only ever happened in 3 moments in history: 1987, 2008, the GFC, and during COVID. Massive moves. Asia Pacific down 7.5%. Again, the biggest drop since the GFC. So real strong price action there. Let's turn to commodities now. I just want to draw your attention to some of the price action that we're seeing in both industrial metals and in gold as well. But take a look at the distribution of price action that we have. Copper is actually rebounding today, up 1.5%. Iron ore down 2.5%. We'll talk about gold. But first, I want to start with the industrial metals. Let's bring in Bloomberg's Martin Ritchie. What do we make of what has been happening to the metals complex this morning? Surely the read is global growth is going down. None of that is good for the industrial metal complex. Why is copper up on the day?
Yeah, we have had a manic Monday in the metals markets. Copper had a big slump last Friday and then followed it up again this morning with another collapse. At one point, it was heading for the biggest 3-day drop since the great financial crisis, since you were talking about history. a few moments ago. But it has reversed. It's gone from 7% down to, I think, something like 1 or 2% up now. Look, there's been a lot of losses already since last Thursday, since Trump unveiled the reciprocal tariffs at the White House. I think you've seen a lot of positions exit the market already. There'll be some people saying, well, that's enough for now. Let's see what happens over the course of the next week. I think, though, that if you were to survey, analysts and investors in the market, they'd be saying, look, given all the uncertainties and risks to the global economy, I think there's room for prices to fall further.
Yeah. Gold is something that everyone's been watching. Up until a week ago, it had a massive bull run, the best quarter since 1986. But on the week last week, it was down 2.7%. Why do you think that is happening? Is there a broader portfolio deleveraging taking place that's also now affecting gold as well?
Yeah, I think that's broadly right. As you said, gold has been one of the big stories in commodities markets over the past year. That really strong run up to reaching record after record, above $3,000 an ounce. But what you see in times of kind of extreme market volatility, such as we've seen over the past few days, even though gold is usually a kind of hedge, it's a haven against global turmoil. You do see in extreme moments people selling off gold. It's a liquid asset. They raise money against losses they're making in other assets. So gold sell-off really points to the sort of, the historic nature of these price swings across markets, I would say.
Yeah, one of those sayings, those financial expressions that throw the baby out with the bathwater. I don't like that expression, but people say it sometimes. Bloomberg's Martin Ritchie, thank you so much for giving us an overview of the price action in commodities. Equity futures, once again, historic day coming up. We've got S&P futures leaning down almost 4%, NASDAQ 4.5%, European markets down 4%. This building on from losses on Friday, which saw all of these indices drop 5 to 6%. So another big day of volatility coming up for markets. That was Horizons Middle East and Africa. I'm Johanna Bersetchi in Dubai. Stay with us for Daybreak Europe.